Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Meta's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Meta is Facebook's new name. It is the parent of Facebook, Instagram, WhatsApp, and many more brands. It is considered one of the world's most valuable companies. The company generates most of its revenue from selling advertisement space on its various platforms. It has 3 billion monthly active users, which is 37% of the world. That is such a valuable asset to have so many people visiting your websites. Throughout history, the way entertainment companies make money, whether it's a radio station, TV station, website, any type of company, the way they make money is the more eyes that view their product, the more money they make, the more they can sell advertising space for. And this company has the most eyes looking at its websites, its apps, its platforms, everything. That's why it's such a valuable company. And I'll show you later when we look at their financials how much revenue and how much profits they bring in from so many people looking at their platforms. In 2012, it acquired Instagram for $1 billion. This is considered one of the best acquisitions ever. In 2014, it acquired WhatsApp for $19 billion. In 2014, it acquired Oculus for $2.3 billion. In 2020, it acquired 10% of Geo Platforms for $5.7 billion. Geo is an Indian company and the third largest mobile network operator in the world with 462 million subscribers. The word meta comes from the Greek language and means beyond. The company changed its name to reflect its long-term focus on building the metaverse, a digital extension of the physical world by social media, virtual reality, and augmented reality features. It plans to spend $29 to $34 billion next year to invest in AI, servers, and data centers. They own Oculus, and that company controls 28% of the virtual reality market share. If you want to fly to space with your cousin or your friend, now you can do it through Meta. You don't have to be a billionaire like Jeff Bezos. If you want to go to safari in Africa, you can also do that through Meta. Meta is going to create the most futuristic and realistic experience for everybody. And you can do all of this from the comfort of your own home. The company is headquartered in Menlo Park, California, and was founded in 2004. When the company IPO'd in 2012, it had 845 million monthly active users, and its website received 2.7 billion likes and comments daily. As of today, it is one of the largest IPOs ever. It trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, Euronext Paris, Xetra, Vienna, Swiss, Santiago, Kazakhstan, Sao Paulo, Italian Bourse, Lima, Buenos Aires, Bulgaria, Ukraine, and London Stock Exchange. Let's get started with the model. This is a large cap company, 937 billion market cap. They're trading at $3.37 a share, and they have 2.8 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they have tons of free cash flow. 15 billion way up to 36 billion. This might be the most profitable company ever. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that also goes up quite a bit from 22 billion up to 40 billion. Revenue is the sales for the company, and that doubled from 55 billion to 112 billion. Growing from 55 billion to 112 billion is just unreal. Growing from 55 million to 112 million is doable, but 55 billion to 112 billion, it's another level of expertise. This is the company's income statement from Yahoo Finance. In a little bit, we'll look at their income statement from the latest 10Q. The top line is the revenue, the sales. Here's a breakdown of their revenue from 18, 19, and 20. So you can see almost all their revenue comes from advertising. Like I said, they have so many people visiting their sites, they can charge lots of money for advertising space. And the great thing about this company is they get revenue from all around the world. About 40% is from the US and Canada, then Europe, Asia Pacific is pretty big as well, and the rest of the world is 7.3 billion. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that doubled from 46 billion to 90 billion. Below that is their operating expenses and then their operating income. And that also doubled from 24 billion to 46 billion. They don't really have any debt, so they don't have interest payments on their debt. And the bottom line of the income statement is their net income, which is huge, 40 billion in the trailing 12 months. Here's the income statement from their latest 10Q. This shows the first 9 months of 2020 versus the first 9 months of 2021. And the top line is the revenue, the sales. Below that is the cost of revenue, that was 16 billion. These are some of the expenses and cost of revenue: the operation of their data centers, technical infrastructure, facility and server depreciation. They have to pay salaries and benefits and compensation to their employees, energy and bandwidth costs. There's also credit card fees every time a customer pays. Sometimes they sell hardware products, and also content costs. Like other platforms, they have to buy content. They don't spend nearly as much money as a Netflix on content, but they do have some content costs. Below cost of revenue is research and development. That was their biggest expense, almost 18 billion. R&D expenses include salary, benefits, and compensation for the employees. These employees are on their engineering and technical teams that build and improve products. And also facility costs like rent, insurance, and various expenses for the supplies. Marketing and sales is 10 billion. You'll notice salary, benefits, and compensation are in most categories because depending on where that employee works and what department, that's the expense category their salary goes into. So your salary goes into this category if you work in sales, sales support, marketing, business development, and customer service. Also, the expenses related to the marketing and promotional items, that also goes into this category. And then professional services such as content reviewers. And the last expense, general and admin, that's 6.5 billion. A big expense in this category is legal costs. This company is constantly getting sued by individuals and also the government. And there's also payroll costs for people in HR, legal, finance, and corporate communications, and various taxes like digital taxes, tax levies, and gross receipt taxes. And also professional services. Sometimes they have to hire an outside person to help them. So their total expenses in the first 9 months of 2021 was 50 billion. Their operating income is 34 billion, and their net income is 29 billion. Revenue of 84 billion, net income of 29 billion. Their margins are unbelievable. This is their statement of cash flows from Yahoo Finance. We're going to look at their 10Q in a little bit to get more detail. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. 53 billion of cash flow. Some companies can operate 100 years and not even get close to generating 50 billion of cash flow in all 100 years combined. And they spend a lot in CapEx, and they're going to spend a lot more building out its meta platform. Since they're going to be spending a lot in CapEx, you should try to invest in companies that will be the recipient of all the money Facebook plans to invest. Companies in the semiconductor industry may be a good investment. Of course, companies in the AI industry. Operating cash flow minus CapEx gives you your free cash flow. And they have a ton of free cash flow. It goes from 15 billion up to 36 billion. And this is the cash that's remaining, left over. And they don't pay a dividend, so they're constantly reinvesting back into their business. That's why they're growing so much. They do buy back lots of stock. That's another way to reward shareholders. When a company buys back stock, it decreases the shares outstanding, making your shares more valuable. They bought back 13 billion in 2018 and 4 billion, 6 billion, and 26 billion. Buying back stock has the same result as a dividend. A dividend forces you to take the money, where a share buyback doesn't force you to take the money. The only way you can take your money is when you sell the stock. This is their cash flow from operations section from the first 9 months of 2020 versus the first 9 months of 2021. And the way you calculate CFO, you start with net income of 29 billion, then you have to add or subtract the non-cash items on the income statement. Because remember, CFO is net income converted to cash. So we have to add back depreciation, stock-based compensation. Those are non-cash items. We also have to adjust for changes in working capital. It looks like they extended $1 billion of credit to their customers. But when they receive that money, it will be a cash inflow. Like in 2020, it was a cash inflow of 1.5 billion. They had a cash outflow of 2.6 billion in prepaid expenses. So they paid for something up front, and they're going to be getting the benefit of that over time. If you were renting your apartment to live in, and if you paid your landlord 12 months up front, that would be the same thing as prepaid expenses. And there's other smaller items on this. So even though they reported $29 billion of profit, they actually generated nearly $40 billion of cash flow. This is their cash flow from investing section and their cash flow from financing section. So the top part of cash flow from investing is CapEx. They spent $13 billion in the first 9 months of 2021. They purchased $24 billion of short-term securities because they probably have a lot of cash sitting on their balance sheet. Instead of getting no interest by letting it sit in a bank account, they purchased short-term securities and get maybe a 1 or 2% return. They sold short-term securities for $15 billion. $9 billion worth of securities matured. They acquired a business for $330 million. So in the cash flow from investing section, they had an outflow of $13 billion of cash. In the cash flow from financing section, they had a $4 billion outflow in taxes. They bought back $24 billion in stock, and they paid $500 million in finance leases. So in the financing section, they had a cash outflow of $29 billion. But most of this was to buy back stock, which is a good thing. It helps your shares. And they could always reissue the stock if they needed to. This is the equity section of their balance sheet. They have $133 billion of equity. They raised $54 billion from selling their business, and they profited $79 billion from running their business. Such a profitable company. Let's look at their capital structure. They have $133 billion of equity, $12 billion of debt. They're 91% equity, 9% debt. Their net debt is negative $45 billion. They have more cash on their balance sheet than almost any other company. I think they're in the top 5 in total cash on their balance sheet. And I gave them the lowest WACC on Finbox, 7.2%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows, past year 4, that's 1.3 trillion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.1 trillion. We divide that by 2.8 billion shares. And we get a calculated stock price of $402. They're trading at $337, so they're trading at a 16% discount. It's a buy according to the model. The average analyst projects their revenue to grow 15%. To calculate their future revenue, I just grew it 15% for the next 4 years. And to calculate their future free cash flow, I needed to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers. I divided by these 4 revenue numbers. And that's 30%. So I multiplied their future revenue estimates by 30%. That's how I got their future free cash flows. The last time I did a video on Facebook was in December 2020. The stock was trading at $276. My valuation was $327. So it's pretty close to where they're trading at now. It is a lot easier to value a company like Facebook with consistent and positive numbers. It's much harder to value a company that does not have consistent numbers or is losing money. Simply Wall Street's valuation is $700. They're saying it's 51% undervalued. If you look at my video back in December, Simply Wall Street was also really high. That seems to be a trend with this company. They seem to value stocks way higher than me. 36 analysts priced this stock and the average price target was 406. The low was 300, the high was 466. This is where the stock has been trading the last 5 years. This is one of those stocks, whenever you buy it, you should make money. Unless, of course, you bought it right before the crash and then you sold. But if you just hold out for at least 6 months, you're going to make money on this stock. It has a beta of 1.27, so the stock moves a little more than the market. It's gone up 24% in the past 52 weeks, while the S&P is up 29%. The 52-week low was 245, the high was 384. And the stock is trading between its 50-day and 200-day moving average. And this is a really popular stock. Over 20 million shares are traded each day. Pretty much all the shares outstanding are on float. 80% are held by institutions and only 1% of the shares are shorted. A bullish sign is when a company adds employees, and they're adding employees every single year, up to 68,000 workers. If you invested $10,000 into this company when it IPO'd, you'd be at $100,000 today. I bought 100 shares when they IPO'd for $40 a share, so I spent $4,000. And the following month, I was down 40%. I sold it after 4 or 5 years, and I quadrupled my money. When I sell stocks, it's usually when I need money. I think that's when I bought my house. I needed money for the down payment. But I did buy back into Facebook a couple years ago, and I'm up about 120% right now. The biggest shareholder is Mark Zuckerberg. His value of the company is over $100 billion. Then Vanguard, BlackRock, Capital Research, and Fidelity. Let's look at their financial ratios. For a growth company, they have an amazing PE. If they were a stable company with minimal growth, you'd want that PE to be low, below 15. But a PE of 23 for a company that grows at this rate is amazing. They have a high price to sales and price to book, but that's fine because they're growing so much. And you could see they have $133 billion of equity. Most of that is tangible equity. They only have $19 billion of intangibles on their balance sheet. Most of their growth is organic. They have an amazing return on invested capital of 42%. That's just unbelievable how well they convert their debt and equity into profits. They have a high ROE of 30%, a really high quick ratio and current ratio above 4. They have nearly $60 billion of cash and marketable securities on their balance sheet, $12 billion of receivables, and $5.5 billion of prepaid expenses. They're more than well capitalized. They generated $36 billion of free cash flow in the trailing 12 months. They have nearly $60 billion of working capital. Working capital is current assets minus current liabilities. So they have over $90 billion of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 19 companies in the same industry as Meta. And you can see Meta is better in price earnings, price to sales, price to book. They have a higher current ratio, a much better ROE, they're really low in debt, and they're one of the biggest companies in the world, nearly 1 trillion market cap. So to summarize, I have them trading at a 16% discount. And this company is my favorite company. I think they have the most potential. I have a bet with a friend that they're going to be the first $10 trillion company. Well, the bet is, I think they'll be a $10 trillion market cap company in the next 10 years. He said that won't happen. So I guess any company can hit 10 trillion and I'll win, but this is the company that I think will do it. A lot of people don't invest in stocks like this because they think it's too high right now. It's worth nearly $1 trillion. But people have been saying this about companies that are worth 100 billion, 500 billion, a trillion, 2 trillion for Microsoft and Apple. Companies like Microsoft, Google, Apple, Facebook, they're so innovative and they have such a big market share, they're just going to keep going up. People think they're going to come down, but they're not. They're just going to keep going up. The only risk is if the government comes in and breaks up these companies due to antitrust violations. But if that does happen, you can invest in the individual companies. I rank their free cash flows 10 out of 10, their revenue 10 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.